Hello, let's talk today about something called the cost of finance, the cost of capital, sometimes they call it. Cost of finance or cost of capital, the same, whatever. Now, look at the balance sheet. The balance sheet of the business shows two most important things. Number one, the investments of the business. The assets are the investments of the business, whether it is short-term investments you benefit from it in 1 year or less, or long-term investments that you benefit from it more than 1 year, like machinery and equipment. Now, the investments here, whether it is current or non-current, you have to get finance for it. You finance it. You finance these investments, whether from liability, from debts, or from equity, which is the shareholders' contributions. These are the financing options and they have cost. They are not for free. You need to calculate the cost of finance to be able to put a target for the return you want to make on your investments, that it has to be higher than the cost of finance in order to be able to create value for the shareholders of the business. So let's look at that. Now, the financing you are going to use will be either from debt or from equity. The cost of debt finance, of using loans in financing your assets to buy machines and the like, it is the interest you are paying, the borrowing rate, the interest you are paying on your debts, times 1 minus the tax rate, as you are taking benefits from paying interests in reducing your taxable income. You are not taking this benefit from equity finance, because when you pay the shareholders dividends, you pay it from net profit after tax. So the cost of debt is the borrowing rate times 1 minus the tax rate to get the tax savings from using this option of finance, which is the debt finance. The cost of equity finance is the required rate of return by the shareholders' investments in the business. The shareholders want a certain return. The return the shareholders want is basically the risk-free rate, for example, like the deposit rate or the rate of the treasury bills and treasury bonds the government borrows with, and they add any risks they might encounter: country risk, market risk, liquidity risk, any other risks they see that they can encounter. All right? Then they decide on something called the capital structure or the financing structure, how much of the investments they want to get from debt and how much they want to get from equity. As a rule, when you are expecting the coming market conditions stable with not a lot of high inflation, you might go to increase the percentage of debt finance to more than 50 to 55%. But when you encounter that or when you expect that the coming years might have a lot of financial difficulties and economic difficulties, it is better to increase the percentage of finance from equity. All right, as shareholders will not demand fixed payments like the bank, they will be more safe. Although shareholders' equity is always more expensive than the debt finance, because the shareholders are taking more risk than the bank. So let's assume that the risk-free rate is 6%, the market risk premium is 7%. Of course, the higher the risk in doing business in the market, the higher the rate you want on your money. Any other company risk you take into consideration. Borrowing rate is 8%, tax rate is 20%. So what is cost of debt finance? Will be the borrowing rate, prevailing rate in the banks. 8% times 1 minus the tax rate equals 6.4%. Cost of equity finance will be the risk-free rate, the rate on the deposits, the rate on the treasury bills of the government, 6%, and you add on it all the expected risks you might encounter. The higher the risk, the higher the return you require. So we added the 7 plus 2, 9 plus 6, 15%. Now, the shareholders of the business, or the board, the executive team of the business, they decided to use 56% of the investments. They will finance it from equity and 44% from debt. So multiply the debt finance percentage in your capital you are using times the cost of debt finance plus the equity finance percentage in the investments you are doing times the cost of equity finance. And you will get what is called the weighted average cost of capital. Sometimes they call it the WACC, sometimes they call it the cost of finance, sometimes they call it the MAR, the minimum acceptable rate of return. This is the key number that you are going to use if you are going to do a feasibility study, if you are going to decide if the business is really adding value to the shareholders or not. This is the key number. Don't ever forget it. Thanks a lot. Have a nice day.